Welcome back to Investing Talk podcast. We've got a really fascinating company on our radar today, and the big question on everyone's mind seems to be, is Richtech Robotics a good time to buy right now? We're going to take an in-depth look. This is a company operating in that really dynamic service industry robotics segment. They're delivering automated solutions for hospitality, healthcare, logistics, even cleaning. We've gathered the sources, dissected the numbers, looked at the news, the market chatter. And yeah, we're ready to lay it all out for you. But hey, before we jump in, if you're finding these insights valuable, please do hit that subscribe button, maybe like this content, and definitely leave a comment. And also, if there's a specific company you'd like us to look into next time, just drop its name in the comments below. We do read those. Okay, let's dive straight into the numbers then. What do the fundamentals for Richtech Robotics tell us about, say, fiscal 2024? Because the picture is, well, frankly, it's quite stark. We're looking at revenue around $4.24 million. That's a sharp decline, over 51% from the previous year. And the net loss, it's staggering, negative $8.14 million.
That's a loss surge of, wait for it, 2,301% compared to 2023. Those are some pretty dramatic figures right out of the gate.
Yeah, what immediately jumps out, like you said, is that significant revenue drop coupled with just surging net losses in fiscal 2024. If you put this in a broader context, it really raises a critical question about their execution, maybe market demand risks for the company. And the trailing 12 months kind of reinforce this. You see revenue at $4.13 million, net income at negative $15.1 million. That results in a negative EPS of minus 0.13 cents. So it's not just a challenging financial landscape. It suggests a real fundamental struggle, maybe, to generate revenue and get costs under control. It doesn't immediately inspire confidence from a purely numbers perspective.
Right. So given those truly, alarming figures, a 2,300% surge in net losses, is there any way to spin this positively for someone thinking long-term, or are we strictly looking at maybe a short-term trading vehicle here, despite these foundational red flags?
Well, looking at what we have, there's no dividend, obviously, a negative PE ratio, and really very limited forward-looking analyst views, although, interestingly, there is one strong buy rating out there. It has a $3.50 price target.
Okay, so one strong buy. That single analyst view does offer maybe a glimmer of optimism, right? Suggesting a potential upside of over 22% from current levels. But it feels like an isolated voice in a very, very quiet room.
You've really hit on the core tension there. The absence of a dividend, the negative PE, and just the scarcity of broad analyst coverage. It makes it incredibly difficult to get any kind of consensus on future earnings potential or, valuation. And while that single strong buy is certainly notable, yeah, for a company with such dramatic recent financial performance, you'd typically hope for a much broader range of opinions. You'd want deeper, independent analysis to build a robust, fundamentally sound investment case. Relying on one optimistic projection here feels a bit like, looking at a single star in a very cloudy sky.
Moving on to financial health then. The market cap, as of today, September 11th, 2025, it sits around $459.67 million. There are about 160.72 million shares outstanding. But here's where it gets really interesting, maybe concerning. Amidst these financial gaps, we couldn't actually find verifiable debt or cash flow figures. Not from the source filings, not from the usual aggregator services. It's not just a blank space. It feels like a significant hole in the financial picture.
That's a critical point. An inability to really comment on short-term liquidity or even long-term solvency because the data just isn't readily available. That's a substantial red flag for any investor. You combine the high net losses with diminishing top-line revenue. It signals severe financial weakness, probably high cash burn. They're likely bleeding money faster than they're bringing it in. And for a small company, 57 employees trying to grow and scale, this is like a ticking clock. It raises serious questions about how long they can even operate without needing significant new funding. Without clear visibility into their cash position, their debt load, assessing their runway or their ability to fund future operations is, well, it's essentially a guessing game. And this directly impacts their ability to innovate, to expand, regardless of the market potential.
So they're effectively operating in the dark financially, at least to us public observers. Okay. Now, Richtech Robotics operates in this, rapidly growing but also highly competitive space, service industry robotics. They offer a broad range of solutions: delivery, sanitation, food and beverage automation. It sounds like they're trying to cover a lot of ground within a promising sector. Does this breadth help them, do you think? Or does it maybe hinder them when the financials are so shaky?
That's a good question. While the sector is undeniably promising, it's ripe for innovation, sure, but Richtech Robotics faces really stiff competition. You've got other electronics and appliance firms like iRobot, GoPro, Universal Electronics. These are often larger, more established players. They have
Mm.
significant resources, deeper pockets, proven track records. The data we have doesn't yet demonstrate strong economies of scale or, frankly, a clear competitive moat for Richtech Robotics. Their broad range of offerings, while it sounds ambitious, could also be spreading their resources pretty thin, especially when you compare their revenue size and trends to those larger, more established incumbents who often specialize or, have dominant market share in specific niches. It's a very crowded race, and they really need a clear differentiator to stand out.
Okay, let's switch gears a bit. Let's talk about the stock's recent behavior. The price today, September 11th, 2025, it's ranged from $2.57 to $2.99. Hit a high of $3.24, low of $2.86. Those are some noticeable intraday swings, yeah. But the real story from what we're seeing seems to be the overall volatility that has characterized this stock for quite some time now.
Oh, absolutely. What immediately grabs your attention is just the sheer volatility. The 52-week range is incredibly wide. We're talking 52 cents, so just over 50 cents, up to $5.20. That's a massive spread, right? It indicates just extreme price fluctuations over the past year. And while the stock is up over 52% month over month and an impressive, 211% year over year, this surge seems largely attributed to speculative trading rather than any kind of underlying fundamental profit growth. The daily volume is significant, sure, around 18.33 million today, average maybe 40.87 million. That certainly facilitates these large, often dramatic price swings.
Okay, but hang on. With a 211% year-over-year climb, isn't there an argument to be made that market sentiment, even if it is speculative, can create its own momentum? I mean, how much does that roller coaster risk truly diminish the potential for continued, albeit volatile, gains? It sounds like an exhilarating ride for some, maybe, but I'm trying to understand the actual foundation here.
You're absolutely right to question the foundation. That upward momentum, while it looks substantial on a chart, it seems built largely on sentiment. It lacks the consistent profitability and the strong balance sheet needed to provide a stable floor underneath it. Think of this stock less like a steadily climbing mountain path, maybe more like a rocket launching on pure speculation. It can soar dramatically, yes, but without that solid engine of profitability, its descent can be just as, if not more, dramatic and swift. And this is really exacerbated by the constant risk of share dilution we talked about. So yeah, it's exhilarating for short-term traders, maybe gamblers, but it's a potentially devastating trap for long-term investors who are seeking stability.
Okay, fair point. Now, despite these challenges, let's look at the headlines, because this is where it gets interesting again. Richtech Robotics has been making some significant waves recently. Just this month, September 2025, the stock surged over 9% after securing a master services contract with a major retail chain. We don't know who yet, but major. And back in August, shares soared nearly 25% because of high-profile partnerships with Starbucks and Domino's. I mean, these sound like major wins that could, potentially, fundamentally shift their trajectory, even with those tough financials in the background.
They are, without a doubt, highly significant ventures. These partnerships position Richtech Robotics right at the forefront of retail and hospitality robotics innovation. It signals strong market validation for their tech. And we also saw them showcase their ATOM robot at the Kennedy Space Center's 75th anniversary event back in July. That definitely raised their public and, VIP profile. Furthermore, they announced an expanded strategic agreement in China with Boyu AI Technology. That's targeting new R&D and deployment opportunities. This doesn't just validate the company's international growth thesis, it also further raises its profile globally. These are definitely strong external signals coming right amidst those internal financial challenges. It suggests that while the balance sheet looks rough, the market seems to believe in the concept and the future potential of their solutions.
Right. So the market's responding to these tangible signs of business development, even if the financial statements haven't caught up yet. It's that classic future potential versus current reality tension playing out, isn't it? So for someone looking at this as an investment, are these partnerships enough to overcome the fundamental financial concerns in the short to medium term?
Well, for many investors, particularly those maybe with a shorter time horizon or higher risk tolerance, these partnerships are indeed enough to fuel optimism and drive trading activity. The market is clearly responding to these tangible signs of business development, adoption in high visibility sectors. It indicates that despite the financial metrics, there's a strong belief out there in the company's technology and its potential to scale within the service robotic space. However, the long-term sustainability still hinges entirely on these partnerships translating into actual revenue growth and, crucially, eventually, profitability. The market is essentially betting on that translation happening. It's a bet right now.
Okay, looking ahead then, there are several key events coming up for Richtech Robotics that could either, confirm or maybe debunk some of this market optimism. We've got Q2 2025 earnings coming up very soon, September 16th, then Q3 2025 earnings on November 20th. These feel like they're going to be absolutely pivotal in understanding their true direction.
They really are. This presents a critical set of questions, doesn't it? Will these earnings releases finally reflect revenue growth from those recent retail and hospitality contracts from the China R&D Center? Expectations are, or at least hopes are, that these could accelerate sales trajectories, maybe improve margins, offering the first real glimpse of how these high-profile partnerships translate into concrete financial performance. Beyond earnings, you should keep a very close eye on October 1st. That's when institutional holdings filings are due. Those will reveal if major long-term investors are starting to accumulate positions, which could provide further stability and validation. And then October 10th for potential ETF rebalancing decisions. That could drive significant stock inflows if Richtech Robotics happens to get added to robotics or AI sector funds, boosting liquidity and institutional coverage. These are all concrete, short-term catalysts that could significantly impact the stock's direction one way or the other.
And beyond the confirmed events, there's also market chatter swirling around. You hear things. We're hearing rumors of maybe a potential U.S. expansion partnership announcement, perhaps another high-profile deal in the restaurant or retail sector. How much weight should an investor really give to these unconfirmed whispers?
It's fascinating, isn't it, how these purely speculative catalysts like potential ETF inclusion or even rumors of acquisition interest from a larger industrial player, how they can influence the stock price, especially for a volatile stock like this one. There's also speculation around them possibly licensing their proprietary AI decision-making software. That would be a whole new revenue stream, potentially diversifying their business model beyond just selling the robots. These all certainly fuel market excitement that can drive momentum, but it's absolutely critical to remember, just as you said, they are rumors. They haven't been confirmed. Investors must always distinguish between confirmed news and speculative chatter, especially in a stock with such a shaky financial footing to begin with. Acting purely on rumor, that's a gamble. It's not an investment strategy.
Yeah, good reminder. Okay, let's be really clear then. With all this exciting partnership news and market buzz, it's definitely not all positive. What are the key company-specific risks that you, the listener, should be acutely aware of, even with these potential upsides?
Well, first and foremost, that rapid revenue decline and the surging net losses in fiscal 2024. Those are serious stock-specific risks. They reflect potential execution or maybe market demand issues that haven't yet been fully addressed or explained publicly. The company also has a pretty thin operating history as a public entity. That just means less historical data for investors to evaluate its performance under various market conditions. It's still very much an unproven entity in the public markets. And this immediately brings up that critical issue we touched on, dilution risk. Imagine you own a slice of a pie, right? If the company needs more ingredients, more cash to keep baking, they might sell more slices to new investors. When they do that, your original slice of that pie gets smaller, it diminishes your ownership percentage and potentially your investment's value per share. With Richtech's current large share count and that substantial negative cash flow, meaning they're losing money quarter after quarter, the need for future capital raises feels like a very real, almost inevitable scenario down the line. That could significantly impact current shareholders.
Okay, so significant company-specific risks. And what about the wider market? What broader risks are lurking out there that could impact Richtech Robotics, regardless of its individual performance or its ability to keep landing these partnerships?
Right. Placing this in the broader context, the service robotics sector itself, as we mentioned, it's highly competitive. You've got entrenched incumbents, constant pressure to innovate just to keep up. That's a formidable environment for any company, let alone one trying to establish its distinct market presence with shaky financials. Beyond those company-specific issues, there's also just the broader market volatility risk. This is especially true for thinly traded names or names largely driven by speculation, which can see dramatic swings completely unrelated to company-specific news. And of course, you always have macroeconomic uncertainties hanging over everything, things like interest rate shifts, changes in overall investor risk appetite, maybe global supply chain disruptions. These can impact any stock, but particularly growth stocks that rely so heavily on future potential and external funding. They're definitely not operating in a vacuum.
All right. So, bringing it all together then, our analysis gives Richtech Robotics an overall rating of 3 out of 10. Can you walk us through the rationale behind that? Well, that rather low rating, especially given all the positive buzz we've also discussed?
Yeah, the rationale is quite clear when you line it all up. We have deeply negative fundamentals, really highlighted by that steep revenue decline and those surging net losses. That's point one. Point two, the significant price appreciation, over 200% in the last year. It seems driven primarily by trading speculation and market sentiment around future potential, not by underlying profit growth or any demonstrable improvement in financial health. Then there's the fact that key financials, like the cash flow position, remain largely unclear due to that lack of verifiable public filings. That's a huge hurdle for any serious fundamental analysis. So while the business does have potential long-term upside if, and it's a big if it can effectively scale its solutions and translate those partnerships into sustainable revenue and, crucially, into profitability, it currently lacks the near-term operational evidence to support this hope. This combination strongly suggests that the extreme share price volatility and the reliance on event-driven catalysts, like the upcoming earnings reports, make this much more suitable for short-term, highly speculative trading. It's not really positioned for a long-term investment portfolio, at least not until those fundamentals demonstrably improve and become significantly more transparent. It feels like a bet on future dreams, not current reality.
Okay, so is Richtech Robotics a good time to buy now? As you can clearly see, there's a strong tension here, a real tug of war, isn't it, between those challenging financial fundamentals on one side and the exciting, high-profile strategic partnerships driving significant market buzz and speculation on the other. It really is a classic case of evaluating that immense but uncertain growth potential against the current financial realities and the volatile dynamics of a momentum-driven market.
And this truly raises an important question for you, the listener, to consider. How do you weigh the allure of that speculative momentum, that promise of future growth, against the cold, hard facts of the current financial performance and the inherent risks of such a volatile market? Understanding your own investment horizon, are you in this for weeks, months, or years? And your personal risk tolerance is absolutely paramount here. Are you a short-term trader happy to chase that volatile rocket ride? Or are you a long-term investor looking for fundamental stability and clear operational evidence before committing capital? Your answer will ultimately dictate how you view an opportunity like this one.
A truly thought-provoking situation, definitely. And one that really highlights why understanding all the angles, the good, the bad, the speculative, is so crucial before making any decision. Thank you for joining us for this in-depth look into Richtech Robotics today. We really hope this has given you a clearer picture to help inform your own decisions. Until next time, keep learning, keep questioning, and keep investing smart.